So without spending more time, let me directly request Shri Deepak Mohanty, Chairman of the Pension Fund Regulatory and Development Authority, the PFRDA, for the keynote address. Mr. Mohanty.
Good morning. I thank CII for this opportunity to be in the midst of such distinguished gathering. The topic, transition from a nation of saver to investors, straddles economic and financial fabric of our country. The transition that we are evidencing now is not just a change in financial behavior of people, rather a shift in belief how we are viewing wealth, economic growth, and financial well-being. Traditionally, households save a part of their income to meet tomorrow's unforeseen expenditure and part in physical assets such as gold and a house so as to leave those behind for the next generation. In the 1970s, unwinding from the informal financial sector, citizens reposed faith in government-owned banks, financial institutions, and insurance companies for depositing their savings, which offered decent returns. These savings then could get deployed in productive sectors of the economic activity. Stock market were perceived as a place for traders dealing with speculation and not as a common man's platform for making investment. However, financial attitudes seem to be changing. Components of households' gross financial assets indicate that during the 15-year period, if I take in the century 2000 to 2016, on an average, 81% of financial assets were held in cash and bank deposits. With investment in bonds and equity, which is a direct investment including mutual fund, just average about 3%. In more recent years, suppose we see the 5-year period from 2017 to 2022, the share of cash and bank deposits has declined to about 46%, and of bond and equity has risen to about 7% in terms of the share in the household gross financial savings. And financial saving for social security, such as insurance, pension, and small savings, have shown steady increase. As we aspire to a high-income country over the next 25 years, we need to be growing on an average of around 8% in terms of GDP. This will require commensurate level of investment. Chief Economic Advisor is there still. I could, if I dare, then in this context, efficient conversion of savings to capital formation is crucial. For instance, to achieve a GDP growth rate of around 8%, we need an investment rate of around 36% of GDP per annum, assuming, of course, a capital output ratio of about 4.5. India, when we did best in terms of capital output ratio, this is in that range, and going forward we do our best in that range if we work. So we need at least investment rate around 36%. This has to largely emanate from domestic saving. Of course, we can afford capital from abroad, which we have been doing for years, but there is a limit as it has an implication for our external balance. The economic financial liberalization initiated in the early 1990s was the turning point for opening up the economy and positioning India as an investment-friendly destination. We saw emergence of private sector banks, financial institutions, private sector insurance, development of capital market, exchanges, and mutual funds. Financial system underwent technological modernization, anonymous electronic trading, and fund transfer, strengthening of regulatory framework for good governance practices, transparency, and investment protection. The institutional foundation of the financial market were reinforced with regulators in capital market, insurance, competition, pension, insolvency, and Companies Act 2013, strengthening corporate governance, transparency, and accountability of companies. The widening of investment opportunity in a trusted regulatory environment offered citizens to earn returns commensurate to their risk appetite and diversify their investment across investments and instruments and sectors. This secured environment, in addition, facilitated demand for long-term debt instrument and in particular from insurance and pension entities. Currently, the retirement savings sector investment is around 50 lakh crore, over 16% of GDP. The pension sector that we regulate, which is NPS, National Pension System, and Atal Pension Yojana, has investment of about 13 lakh crore, out of which infrastructure investment is about 2 lakh crore. Equity investment by this cohort of pension funds is about 2.6 lakh crore. As our income levels rise, this sector is poised for growth, as in advanced countries, for example, such as in OECD, that we see pension assets on an average is about 86% of the total GDP. So then we have a long way to go and catch up in that process. The financial inclusion drive by the government played a pivotal role in making formal financial accessible to all, as reflected in 53.2 crore Jan Dhan Bank accounts of low-income and underprivileged people with deposits of about 2.3 lakh crore. It also helped to improve financial literacy at the bottom of the pyramid. Technology lowered the barrier to entry to financial markets and reduced cost. Was to earn better returns over traditional deposits, fueled with smartphone usage. Households owning smartphones actually has increased from 36% in 2018 to about 74% in 2022. The rise of fintech facilitating easier access to financial information, investment opportunities, and artificial intelligence-driven portfolio management tools, the avenue for investment has expanded with increasing affordability. The change in financial behavior and attitude from safe or risk-averse to taking risk for growth of wealth is quite evident from the rise of demat account holders, so about 16.2 crore, and mutual fund SIP account about 9.34 crore. Emergence of number of online equity trading platform, share of retail investment in equity cash segment turnover, rising to 36% in 23-24 from 12% in 13-14. Appetite for newer instrument led to introduction of digital gold, alternative investment funds, real estate investment trusts, REITs, infrastructure investment trust, InvITs, green bonds, exchange traded fund, cryptocurrency, crowdfunding, peer-to-peer lending, etc. With focus on innovation and startup ecosystem, venture capital investment are attracting investors, including individuals, willing to take a higher risk for potentially higher returns, with the expectation that the startup turning unicorn will provide substantial multiplier to their investment. While the progress made so far and the journey of the average households has been impressive, there is need for greater depth in our financial sector to provide the scale and risk capital commensurate with our envisaged growth trajectory. Second, innovative mechanism need to be developed to bridge the financial gap in productive sectors such as small and medium scale enterprises. Third, as the conduct of finance is becoming increasingly digital, so also the associated data privacy and cyber security risk, which require mitigating steps. Fourth, there is a need to make concerted effort to improve financial literacy, including awareness of cyber risk for all sections of our population, so that individuals understand financial risk and make the decision commensurate with the risk-bearing capacity. Fifth, for the regulator to have a robust mechanism for consumer protection becomes important. Finally, this transition underway from a nation of saver to investors makes a paradigm shift in our economic and financial landscape. It reflects our growing confidence in the financial system and its regulatory underpinnings, improving financial literacy levels, and broader investment opportunities. It is incumbent on all the key stakeholders to see that this progress is on prudent lines so that confidence is retained to best serve the real sector. By nurturing a culture of informed investing, we can build a stronger, more resilient economy and that benefits all the segments of the society. Thank you.